I'm already teaching them about the 30% rule. If you just understand that and make your payments on time, like, you'll be good.
What's up, guys? Today we have special guest Jason Zeager. He helps people get money for their business and fix their credit. Welcome to the show, bro.
Thank you.
Dude, so like one of the things we talked about before this is you help people take out bad loans to fix their credit. Is that correct?
Well, not all the time, but yeah, definitely sometimes. So there's like shorter term loans. It could range between like 6 to 18 months.
Okay.
Where it's going to be higher price, you know, similar to credit cards. It could be high teens to like 20s, even 30 or 40%.
So we're looking at, like, let's say like a business owner or an investor or entrepreneur who they've got bad credit and they need a way to fix their bad credit. And so can you describe like the scenario
So a typical process that a typical client that we would see, they commingle their personal and their business credit.
Okay.
So meaning they have stuff on their personal credit that shouldn't be there because it's for the business, but they use their credit cards to fund it. So
like their personal credit cards to fund their business.
Personal credit cards. So like maybe they got 50 grand on personal credit cards.
Okay.
And they have $65,000 limit, right? Their score is going to be like a 650 FICO score.
Okay.
650 FICO score, no bank's going to talk to you. And maybe you can't even get a mortgage sometimes.
Okay.
So we have to take out the personal credit, put that down to zero if possible, or like less than 30% is kind of like our
when you're talking about like the credit, there's 5 things that affect your credit score, right? So your credit score ranges from, let's say, 300 to like an 800, around that range.
Yeah, 850.
Over 700, over 750 is kind of where you want to be at. If you're a business owner and you're below 700 or like 500 or 650, you're going to have a very hard time getting funding for your business.
Correct, yes.
So you're saying like they use their personal credit cards to fund their business ventures. And can you break down how like your credit score is built and like how that affects it?
Yeah, so a third of your credit score is actually based on pay history.
Okay.
A third is based on utilization.
Okay.
So let's say you have a client here that's got, let's say, $20,000 in credit card debt.
Okay.
But they only have $25,000 limit.
Okay.
You're going to have bad FICO score. Even if you have on-time payments, you'll be at 650.
So even if somebody, like, they always pay their credit cards on time, they did all the right things, they have a long history, they did everything right according to like the responsible responsible citizen. But if their balance on their credit card is too high, then they're going to get a bad credit score.
Percentage.
Okay.
Percentage is the key. So you had the same client, $20,000, $25,000 limit. But you could have the same person have $40,000 in credit card debt, but $200,000 in credit card limit. That client will have a 750 FICO score probably because their utilization is 20% versus utilization of like 80%. Okay. So we suggest clients do like 30% or less across the board. So that's what I tell everybody, 30%. If you do 30% or less on every single card, doesn't matter what limit you have, you'll hang out at 720 or better. Pretty much, if you pay your bills on time. If you have choppy pay history, that's a whole nother beast. Like, we're not a credit repair agency. Yeah. I would refer that out and help dispute it.
Because that's the times when you got to actually go to the credit bureaus and dispute all things. Yeah. That's a whole nother,
That's a whole nother game. Yeah. But most clients that we see, they have maybe 1 or 2 slow pays from like COVID, right? But then they're just overutilized. They're over leveraged on the credit side because they're a small business owner. They run all the things, right?
As a small business owner, whenever you're starting a company or entrepreneur, nobody really teaches you about finances, right? No. So you just figure out, you're just trying to like figure it out as you go along. The typical thing is like, hey, I need to buy like equipment. I need to like pay for supplies or with my rent or whatever things for my business or whether my employees or my team members. Let's just put it on my personal credit card. Yeah. And what you're saying is like when you do that, you're kind of shooting yourself in the foot.
Totally, yes. Because and a lot of your people are real estate people, right? And so you need to have strong DTI. Yeah. You need to have strong FICO scores to qualify.
Most of the times for investors, the DTI is not important, but the FICO is for taking out hard money loans when working with banks, etc. So like we don't usually buy things off DTI, but then like bank financing, whether it's long-term rentals, DSCR loans, whatever it is, the FICO makes a big difference. Yeah.
So and it really comes down to like the algorithm. Like if you know how to work the algorithm, you can get very favorable results. So if we see somebody that has a lot of debt and that's really their only problem, it's a fairly simplistic solution. You either have the money to pay it down, get a loan from somewhere. Ideally, it's not going to be on your personal credit, because if you get a loan on the personal credit, it'll help, but you're still carrying all that debt, and you're going to have a new account. Can you walk us through like an actual story of when you guys like or helped a person like this? Yeah. So there was a client earlier this year on Oahu. They had a therapy business, right? And they'd been in business like 10 years. Wow, okay. Tough time coming out of COVID. Okay. She had personal things happen, also business things happen, bad things with a partner. It was a messy situation. Luckily, all on-time payments, though. Okay. So she had a 670 when she first came to us, but she's like maxed out, 80, 90 grand on the cards. Okay. Business credit cards, also same thing. Really, all maxed out on personal and business credit cards. And I think it was like First Hawaiian Bank. She had a line of credit that was coming due because they called the line of credit home equity line of credit or business line of credit? But business line of credit so the way the lines of credit works is you go to a bank and then you take out a line of credit which you have access to funds. You borrow it against it. You only pay interest when you have it out. Correct. But the thing about the lines of credit is at any point in time, the bank can just say, hey, we want to get our money paid. Yeah. If they do that, I know that happened during like the 2008 crashes and things. Yeah. Then like you're like, hey, like when it comes due, like you just got to pay back everything, even though like you don't have the money to pay it back. Right. They give you 90 days, 6 months sometimes. We've been running into this a lot this year for some reason, with a couple of the major banks out here. So if you have a substantial line of credit, I'd say anything over like 100 grand. Okay. They're gonna check you probably about every year. Really? How do they check you? Credit score, they'll check. Wow. Basically, they'll like reapply. So they'll look at your financials, and if you lost money, which a lot of people during COVID did, right? Especially consecutive years. If you lose money, then they're like, okay, well, we need our money back now because we don't trust that you're going to pay it. That sucks because when you lose money, that's when you need the line of credit the most, right? And so you're kind of in a bind here where you owe money, you lost money, so you don't have money to pay it back, but now they're calling it due. So it's kind of screwing you over. It is like banks, they're not really like, they're not your friend. Yeah. I mean, we have had clients that have like 30-year relationships, and then they call their line of credit like just because of 2 bad years, substantial size company. But kind of going back to the therapy client, right? So 670 maxed out everywhere, kind of a thing, and but fortunately she had good revenues. She's doing like 1.5, 1.8, somewhere around there per year. Million. Yes. Okay. So we got her a short-term loan. It was about a year, and I think it was like 120,000, and she used most of that money to pay down her personal credit. Okay. Because we told her we can't, we need better credit to qualify you for like better loans and better loan structures. So that was first thing. So she paid that down. In 30 days, she went from 670 to 760. Wow, this is a big, just from paying down that personal like credit card? Because everything went to zero. Okay. Right? And so, she had 100,000 worth of credit limit. Yeah, so she's got good, like so strong her utilization ratio becomes like very high after paying out. But you took out the loan in a business? How did you get the money for this? So, okay. It's in the business. Okay. It's based on the revenues of the company. And so like we funded the deal in like a week. So, okay. So wait, she has maybe like 80, 90 grand in personal credit card debt. Yeah. She has how much in like business credit cards? It was a little above that. Okay. Like another 100 in business credit cards, and then a line of credit for the bank. About 150. 150. So like, so she has maybe like 250 in credit or like debt with the business. Yeah. And then about like 80 or 90 with the personal. On the personal. You're able to find her another 100 something on the business side, even though she has that. And you're using that to pay down her personal credit, instantly boost her credit score back up to 760. Correct. And so right when we did that, she got a loan for, it was like 270. From the business side or the personal on the side? Business side. Okay, interesting. It was off her personal credit. Okay. So because her scores went up, right? So now she can qualify for different things. So basically able to refinance. The line of credit got paid off. Okay. Business credit cards got paid off. So she was able to pay off that line of credit that came due, right? Like that's like the thing. Okay. So she got everybody off her back basically. Okay. And so now she had our loan, the 120 loan, and then the 270 loan. Okay. So then everything's clean. Okay. But now she has no line of credit. So then we got her new credit line.
Oh,
so
wow,
we get
wow.
business credit cards, as well as like a new line of credit with a new bank.
You really saved the day for this therapist.
Yeah. And now, we found out later she's at 800 FICO score
Wow.
because good pay history, right? And she's now hiring more therapists to grow the business again, right? But she couldn't really do anything because she was so much turmoil from like the bad partnership, like hair on fire with the financial situation. You can't think properly.
The thing is, like, whenever you have people, I guess, who like you owe money to, or like they're asking their money back, and you don't have the funds to pay for it, I feel like it's like it'll be like it's very stressful, and you can't make good decisions. Like whenever like you're in distress, you just make bad decisions.
Yeah. Like I actually, like, a buddy of mine told me after we got him some credit lines, I was like, yeah, so how was the loan or whatever? He's like, it's fine. Like, we don't really use it all that much, honestly, but it's my peace of mind. And that was like my light bulb on how we help people. Like, we give them the peace of mind to not have to stress out about payday or stress out about, if I go get this big project, like, can I actually fund the deal all the way through? Yeah. If you have credit to your name, especially under the business, you don't need to worry about that. So then they can like get their head above water and like think of actually, how do I grow how do I work on the business, not like in the business all stressed out.
It's kind of like when you look at an average person when you're living paycheck to paycheck, right? Like
exactly.
You're just worrying when the next meal, where can I make a buck so I can pay my rent. You can't think long term or make like long term decisions. Same with a business owner. If you're just like, hey, I just gotta make payroll for this week, or I just gotta make sure like I can whether pay my vendors or whatever things is, then like you have like you don't have the mental capacity to like, okay, let's set aside this or make some strategic moves that will actually impact us in the long term.
Right. Yeah, exactly. So, I mean, and when you're not thinking about long term, you're just like going through the motions. Like, you're just survival. Wheel, right? You're in survival. Yeah. That's it. And you're not really going to you can't thrive from that space.
Yeah. I feel like someone once told me there's four levels of business ownership. I don't know if you've heard this before. So there's there's like survival, when you're surviving. There's when you have enough to, I don't remember them exactly. There's one, there's enough. Okay. Like now you're above surviving. You're kind of doing well. Then later on, like the last one is like, you have more than enough. Now you can give back. Yeah. But I think like as you're going through those levels, each level has its own unique problems and challenges. But the survival level, I think, is always, I don't have enough money to survive. Right. It's always a financial survival in the very beginning.
Yeah. And it's probably like the most important one because I think, most small businesses, they fail. Yeah. Right? I don't know what the number is.
Like a super high percentage, I know.
Yeah. It's well over half within the first 2-3 years. But if you get past that mark and you just like be around, you'll naturally just make it. Yeah. Like you'll figure stuff out along the way if you can.
The sad part is a lot of guys, they actually are making money as a small business, but then like they can crash because they don't have like either the funding or the line of credit to sustain them, right? And so I think this is like, I've seen this with investors, I've seen this with other small business owners where the business is actually making money. Yep. But then there's a cash conversion cycle. There's other things where like they needs funds to make sure that the business is operating, either borrowing from banks, small business loans, or credit lines or whatever things. If they have the access to the cash, then they would survive through like the dips and the valleys. But because they didn't have access to the cash during that time, it's a chain effect where everything else crumbles because this one thing is just, they didn't have like the last 10 grand they needed for like this one piece, and then boom, like the whole like business like kind of just like crumbles,
Yeah. It happens quite often because people can, there's plenty of work out there. There's plenty of jobs that you can get. Yeah. But if they're not able to manage their cash flow, that could put you out of business,
That's another thing too, is like a lot of small business owners, when you first start in the small business, you're like, hey, how can I make money? Yeah. But you never like learn how to manage cash flow, which is like a very, very like, it's accounting. Very different. Like where's my money coming in? Where's it going? Like what's going? And so like if you don't have a good like handle that, I think when I first started, I didn't know anything about accounting. And so like eventually when I figured it out, I was like, I've been doing this thing wrong the whole time. Yeah. Now we have a financial controller, which is so helpful for us to see where the cash is coming in, where it's going out, be able to manage and plan ahead, But without that, I mean, like when you're just starting out, funding is such a crucial part of like the small business.
Yeah. Well, and to kind of go back to your point, like before you had the controller, you're just kind of like flying by the seat of your pants, like going day to day, week to week, month to month. Like, yeah, deals are happening, but like, oh, maybe I'm not saving money or whatever. Like, we're not really thinking about what the future's going to hold. But when you got that controller, then you're like, you could project 6 months out next year. You already know what's going to happen. Yeah. So you can plan
guessing,
for that
right?
stuff.
So, yeah. And also when you have like kind of like the books, you can see where is my highest ROI? Like where my marketing spend that's making me a lot of money? Where is my marketing spend where I'm just dumping and wasting money, right? Helps you just make better decisions over on your business.
Yep, 100%.
So I mean, like you save this therapist. It sounds like turned around like a lot of her stress, and then now that she has a mental bandwidth to kind of like make better decisions, now it seems like she's thriving and she's in a better place financially. Yeah,
exactly. Yeah, and we always try and another thing that I've realized doing this is there's a lot of trust that comes after that, and then
with you guys, you mean like
like because we see your we see the whole thing.
So that's the thing. Another thing too is like a lot of business owners, we don't like people to look into our books because it's kind of like they see you naked, right? It's like it's like a very personal thing to see like my books, right? And especially like let's say like on social media, whatever, people like we like to portray ourselves as doing better than we actually are sometimes. So when you show like let's say you're another person, like, hey, here's I actually only made, let's say, like this much this last year, or I lost money, whatever it is. It's a very like exposed kind of like feeling to share with somebody else, right?
And I find myself like I have to just keep my mouth shut about clients. Like, don't share too much, you know, because they do have reputations and stuff like that. So, but
I'm sure you probably see it all the time, right? Where like somebody looks like, I mean, even for us, like we probably are looking like we're a lot more successful on social media than we are in real life. But then when you see like the books, they're not going to reflect the exact amount that maybe people perceive that you're making, you know?
Yeah. I was a little surprised, like seeing a few kind of like, you know, social media gurus or whatever that kind of come across. I'm like, oh, how come your credit score is not in the sevens? You know, like it's not that difficult. But yeah, I think there's a lot of over leveraging that's happening these days. In
investors,
in general,
entrepreneurs, everything.
Just across the
personal people, just people with the W-2, right?
Is that. So, you know, we just follow what the country's doing. Was it 36 trillion?
Yeah, I mean, it's kind of like a mindset thing, I think, where like, oh, we don't have enough like money, let's just like leverage more, right?
Let's go get another card. Yeah, exactly.
But I mean, it's kind of what you guys do to a certain point.
It is.
But then there's also a nuance to it. So I think when you guys are helping these business owners, is there any kind of educational piece that you're kind of helping them to figure out how to navigate?
Whenever we talk to clients, like even like on our very first call, I'm already teaching them about the 30% rule. Because in my mind, like if you just understand that and make your payments on time, like you'll be good. You could qualify for mortgages, car loans, like business loans, pretty much whatever you need if you have 720 plus.
Okay.
You know, that's kind of the first barrier to entry to get any type of loan done. Yeah. So in regards to the education piece, we teach about the 30% rule, which is the 30% utilization across the board for any credit lines on the personal side. And then what we're actively trying to do with the client is we want to put them in the right spot so that they can grow from where they're at. Okay. So I call like we very much work with them holistically. Okay. Like, where are you at credit wise and financials? Where are you going in short term and also long term in your business? Where are you trying to go? I'm going to set up the right mixture of loans and credit based on the short term and the long term goals of that client. And we want to give them the right foundation. Yeah. So that's what I teach a lot of is like foundations of business credit and personal credit. And then also like loans versus lines. That's another huge
Can you break
thing.
down what the difference between a loan and a line is?
Yeah. So a loan is like a fixed period of time. Okay. Monthly payment.
Let's give it like a real world example. So let's say you take a loan for $100,000. Yep. And your interest rate is 5% or something. So
yeah. So let's say like your loan would be like you got a 5-year term. $50,000 loan, you got a $1,000 monthly payment. Okay. You're gonna make that monthly payment no matter what. Even if you pay $20,000 extra, your payment's still $1,000, right? Until you pay the thing off, you'll just pay it off faster. Right, kind of like a mortgage. Yeah. And then a line is like a HELOC, like in your world, or like revolving line of credit, like a credit card or a line of credit or a HELOC. you're just paying based on the number of days that it's sitting out and the amount of money that you're using. So like if you took out $50,000 tomorrow and then you pay it back in like a week, you might only pay like $100.
So the difference between, like, let's say a loan is you take out the entire loan, you get the lump sum all at once, and you just pay that back slowly over time on a set schedule.
Yeah, it's a set schedule. Like you can prepay it. Yeah. You'll pay down your principal balance. But you're paying down
your principal and interest in every payment.
Yes. The lines is going to be a lot more flexible because that's more for like money coming in and out. And the rule of thumb that I tell clients is like, especially on the business side, if you have something that you're going to pay off in like 1 month, 3 months, maybe even 6, okay to use line of credit. Never put equipment on a line of credit. Most people do that. You know, they're like, they fill up their line of credit with like long-term assets. That is not the thing to do. You want to finance that over a long period of time. Use your line of credit for stuff like payroll, or I got to buy inventory, or maybe my competitor went out of business. I could scoop up some, you know, equipment, 10 cents on the dollar and flip it real quick.
I see.
It's for like in and out.
So the lines of credit is more short term because like you're going to borrow money against it, put it back, borrow it again, put it back, borrow it again, put it back. So that's kind of the cycle you want to work with when you do lines of credit. So
for sure, less than 1 year.
Okay.
And the banks, this is why banks call your line of credit, because people put like a piece of it, like a truck. They'll put the truck on the line of credit, 50 grand, and they'll make like $500 payments on it, so it doesn't go anywhere.
You see, so the line of credit's not getting paid down. They're just paying the interest parts of it.
Yeah, they're just paying interest and just letting the money float. So the bank's like, well, no, we're gonna make you pay this back. We're gonna term you out. So they'll close the line of credit. They'll say, okay, we'll give you 3 years to pay this thing off. Now your payments.
So you can actually a line of credit can turn into a loan at a certain point.
The banks can do that, or they could just straight tell you like you owe this in
90 days.
90 days.
So it kind of depends on
demand letter.
How the bank feels. They can, when you have a line of credit, you borrow against it, you put it back, you borrow against it, you put it back over and over. At a certain point, the bank can say, hey, we want our full money, everything in 90 days, or they can say, hey, we'll give you 3 years to pay it off in basically give you a loan at that point. So
Yep. Okay. And a lot of, I mean, the calling of lines of credit is one of the most dangerous things. Like I've seen multiple like $1 million businesses go out of business because in 2008, like that was like the start of my career. Yeah. But I would have people, they're like, oh yeah, my bank just called my like $1 million line of credit. And this was in the financial crash. Yeah. So they give you like 90 days. And if you don't pay it.
In the financial crash, you don't have money, like money's not coming in.
There's no access to money either. So they lose everything. Wow. Just in one fell swoop. So I tell people, like, you don't want to be married to your bank. Like I recommend working with 2 banks at once, actually. So like have a backup, like you need an additional credit line just in case something happens to play it safe.
So, I mean, like when would you say is, like, what's like the responsible way to like, I guess, prepare yourself in like as a business owner when you're taking out lines and loans, like having 2 banks?
So I think diversification is actually a good thing.
Diversification in.
So traditionally people, especially here, they'll do everything at their bank. Like they'll go CPB for their personal mortgage, house, cars, business. What if CPB doesn't like you one day? Or you can also max out your exposure at CPB. Better to like split it up. So like maybe you've got a relationship with Chase for your car or something, or your credit cards. And maybe you just use CPB for like your house or something like that. But you want to like put your loans and your lines at different banks, so you have exposure at many different places.
Interesting.
Now you have more banking relationships, more flexibility. Now Chase is going to ask you, hey, Daniel, do you want to finance this mortgage, with us? Because you're paying good on your credit card here. Or do you need a car? We'll give you a good deal on a car. See, Bank B is going to do the same thing. Bank C is going to do the same thing. So you have a lot of access to credit if you do that.
Interesting. I mean, like, it's very interesting. I've heard like both sides. I've heard somebody's like, hey, just go on one bank, they'll give you better deals. Other ones, like they're saying now, is like, hey, diversify just to like diversify your risk, I guess, right? And also your opportunities.
Yeah. I mean, it's okay to like go to your bank repeatedly for different things. Just like don't go to them for like 100% of things, especially if you're going to grow your business fast, because they cannot keep up with growth.
Got it.
Banks look at previous history. They can't project into the future. Like, I mean, I see what you're doing. Like, a bank could not keep up with you. You got like,
what do you mean by that?
You got like 30 projects or however many, 50 projects going on at one time. A bank couldn't keep up with that level of exposure. They would be too exposed.
I see.
Too risky.
Too many
to
loans.
deal with that.
Too many projects.
But to take on 1 or 2 or 3 deals at a time, not a problem. They love it, right? But they're not trying to have like a $50 million portfolio with you.
I guess that's actually true. I've actually experienced that where we talk to different banks and there's like they like you to a certain point where like, hey, like we feel comfortable like loaning you, let's say like $2 million max. Yeah. And then once they hit that cap, once they hit that cap, it's like, okay, like you reach your limit of exposure with us. So now if you want to borrow more money, you've got to go to like a different bank for whatever like things. And so we've seen that happen. So I think like banks want to make sure that you're not like their entire customer and all like their books are too big of our portfolio. Yeah. Otherwise, it's more risky for them and you, right? So,
exactly. Yeah. Like, and I don't like maxing out at a bank. Like, you know, in that scenario, if you got $2 million to play with, maybe you do $1 million with them or $1.5 million, and then you go to the next bank after that, start paying down your notes. Watch, they'll come back in like a year, like, okay, so, Daniel, you've been paying on time. We trust you. Yeah. Let's bump it to 3.
Interesting. So, I mean, like in this example, let's say you've got, let's say like $5 million worth of projects you're funding, right? And so like you say, like this guy he'll give you max $2 million, but you say, hey, I'm only going to take $1 million here. And this other guy, same thing, like 5 different guys, like I'll give you max $2 million. You can just go, or $3 million. I just could go to like 2 guys and get all my loans, but I'm maxing with the bank. Yeah. As opposed to that, you just go to like, say 5 different banks, $1 million each. But then there's like, well, under the cap, over time, like you're paying down the loans. Then they're like, hey, let's all increase to like, now you have access to $5 million with us because you've been a good customer. Now when anything happens, you have like, let's say 5 relationships with 5 guys who are like, hey, I've got this big deal. Who wants to take it? Or can I do $5 million with you now? Or et cetera. So that's really interesting.
Exactly. Yes. You want the banks like, you don't want to go to the bank like, oh, please, like, can you approve my deal? You want them to come to you and be like, hey, what you need.
That's
right?
very,
Turn
very
the tables a little bit.
That's very, very. I mean, we're gonna have to maybe talk with our team and see, like, because we're kind of like, hey, we just want to be loyal to like one bank, assuming that they're gonna give us like better terms or better rates, you know. But I mean, that's kind of like been our thought process. But after talking with you, maybe we might want to diversify a little bit. We'll see.
I mean, you could put like a bulk of your stuff, but just like don't go all in, you know, because what if they change their regulation? They could change after the election. Yeah. Right. Like something can change, or like maybe they went out of business. Then what do you do? So always have some type of backup, at least one.
So I mean, so when, let's say I'm a small business owner or entrepreneur investor, and I need to take out, like, I want to use their services. What exactly does that look like, and what do you guys provide?
So yeah, we have a pretty simple like onboard process. We get a 1-page application. We'll get at least credit report.
Is it a hard pull or soft pull?
No, we actually have the clients pull their own, so there's no inquiry whatsoever. Okay. And then so we'll view the credit. We'll analyze the credit report. Yes, but we're basically setting you up to like get the best shot at getting a deal approved. So depending on what they're trying to do, like if it's equipment or real estate or working capital or credit, we'll get a combination of like tax returns, bank statements, or whatever. Sometimes all it is a credit report and an application. That's all we need. You know?
Depending on what you're trying to do.
Depending on the size and what you're trying to do and stuff like that. And then after that, we analyze it like, okay, we could do this most likely. Do you want to do it? Yes. Okay, we'll send you the agreement, and then they sign off. We don't collect any money. We just work off of success. So like we say that like we're in the boat rowing with you. Okay. So we're going to go to the end. If we fail, you don't even pay us. Wow. But we're going to stand behind what we do. Okay. So, but once you get paid and you have access to that money, then you can pay our invoice.
So once you guys actually secure the funding, that's when you guys get your payment. Yeah. So if you guys don't get us any funding, then you don't get any payment.
Right. Then we work for free. So we're not going to take every single person.
Interesting. Yeah. So what is kind of like your like average amount that you get like a small business owner, would you say?
Probably somewhere a little over 100K is about the average these days. But we kind of get a very wide range.
What's the most you've ever gotten a guy or a girl?
Just under 6 mil.
Wow. Yeah. I mean, that's a lot of money to I mean, just you working with you guys to have access to 6 mil, like that's huge, I'd say. So.
Yeah. Well, I mean, if you can imagine, like we work with a lot of different lenders. So again, we're playing the cards for the clients. So it's like, we'll take them over here. We did a $5 million over here, and then we'll chop it up a little bit. We do a little bit over here, a little bit over here. And then I know they're going to need a refi in like a year or two. So we'll take them to like a good bank.
Okay.
At that time.
How do you guys, a little behind the scenes here, are you guys just building relationships with like a lot of banks? How do you know which banks are to go to and like which lenders, like all the different products? Because one of the things I like about like working with a mortgage broker, like for a lot of our loans, is they have access to like a lot of different like products, a lot of different companies. Yeah. Versus like, let's say like a single lender, sometimes they have the better rates because like, they don't have like a mortgage broker fee, but then they have like only like their product, you know? So like, how are you guys able to source all these different? Is it all local? Is it like national? What's kind of like your process?
It's all over. So I've been in the space for small business financing for over 20 years now.
Wow. Okay.
So I came from the mainland initially because I grew up in California. So initially it was a lot of that, like mainland lenders and stuff, just knowing of them and like colleagues that had moved on or whatever. So you kind of network on that. And then more recently, like building a lot of relationships out here with lenders, mostly like banks, but some kind of like private stuff as well.
Okay. So you guys do work with some private investors here and there.
Yeah. There's definitely like lots of private, call them like funds or whatever, especially on the bigger real estate deals. We just have a very diverse background of different lenders.
So you're like your job is basically just making as many friends with as many lenders, trying to find all the best deals around, and then you're matching it to like whoever your client is for that.
Pretty much, yeah. And then a lot of what we do too is and what I really would like, my long-term thing is like building deeper relationships with the banks here to do the declines.
What do you mean by that?
Like all the deals they can't do. Cause like you said, like a bank, like whatever, First Hawaiian, right? Like, none of the banks here can do startups pretty much. Okay. So all the startups need money. So where are you gonna go? We're like,
so we can, if I'm a startup, I go to First Hawaiian or Bank of Hawaii. They're like, sorry, you don't have any like history, you have no income. I'm not gonna give you any money. Yeah. But I can come to you and you can help a startup to kind of get started on their journey.
Yeah. It might not be like the perfect deal, but like we can actually get you started, get you something under the business name at least. Get you going, get some credit going, maybe one small loan, 1 or 2 small loans. We could do equipment right out of the gate, no problem.
So I mean, basically, if like for like say you make friends with the guys at CVB or whatever, and they're like, all the loans that they decline for entrepreneurs, like, hey, we can't do your loan, but hey, this guy Jason might be able to help you out. Then that would be like a book of business for you to actually fill a niche. Number one, it's like you'll make money, right? Because you're a business. But number two is you're filling a niche where these guys who want to start their own business or get started up, they don't have any access or like the knowledge to get started. Right. You can actually help them like on their journey.
Yeah, and it works for the banks too because we're not in direct competition with them because banks actually don't want to do a lot of loans. It doesn't make them that much money. They want deposits right now. And there's a liquidity crisis out there if you weren't aware. Like banks need to retain their money.
Can you explain that a little bit more?
So, basically like, fractional banking.
Yeah.
So
I mean, so can you, for maybe like the simplest terms,
I'll make it stupid simple. Okay. So like a bank, if they have $1 million cash, they can lend 10.
Okay.
And even higher sometimes. Okay. Like it went to 100 and even beyond.
So the bank. So let's say like I'm like a customer. Like say let's say you're Bank of America or Bank of Hawaii. Yeah. And so I'm like, hey, Mr. Bank, I've got $1 million. I'm going to deposit with you. Yeah. I deposit $1 million with you. Now you can lend $10 million out to other customers, even though you only have $1 million in cash.
Yes.
Okay. So I mean,
So
and that's
they're,
what
like, super duper leveraged.
that's what fractional banking is, right? And the government allows this.
Yeah. So they can just.
Okay. They lend out $10 million, even though they only have $1 million cash.
Yeah.
So, but why? So, isn't like lending like their bread and butter? Why do they need deposit? Like, why are you saying like they?
So you remember what happened with like First Republic and like Silicon Valley Bank about a year ago?
I mean, I know they went out of business. I don't know what.
Essentially, they had like a bank run. So Silicon Valley. So like if you hear, okay, like FDIC insured banks. You heard of that, right? You put your money in the bank, it's insured up to $250,000.
Yeah. Okay.
Okay. So now, but if Silicon Valley Bank, what happened with them was basically they heard that, like, people heard through the grapevine, like, they're struggling or whatever. So the first guy goes and takes all of his money out the bank.
Okay.
Then his friend goes and does that. Okay. And then it just creates a frenzy of people taking money out the bank. Because the bank has no more money left.
This is like a downward spiral because like it's just like how like when the bank calls your loan due and you're a small business and you don't have income, like you can't pay it back. When the bank, when they're struggling to make it or to do well financially, when people start pulling their money out, it hurts them even more. Yes. Which now they're struggling more, so more people hear about it, and so like now they pull out more money. So like this downward spiral where literally a bank can go out of business just from like a bad grapevine.
Yes, that's what happened to a couple banks, whatever, like a year or two ago, right? And so in commercial real estate, especially, like there's variable rates that happens, especially after 5 years. So all those COVID loans that they did back then. Maybe 3-4%, 5%. Now they're 7, 8, 9%. All the SBA loans that were done, they were 6% before, 5%. Now people are paying like double-digit rates. So banks have defaults to deal with because people can't pay their payment. They have less money. They have no liquidity. So they want to retain money right now. So like there's a lot of local banks, like they don't want to do much loans unless it's super, perfect because they're trying to survive and like make it through this rough patch.
Interesting. I mean, it's really interesting how there's cycles in the banking industry where sometimes like they're trying to give as many loans as possible. But like you said, maybe like right now they're trying to retain as much or get as many deposits, and I guess it matters on the economy, like their financial situation specifically.
And every bank is very different too. There's some that are like way more aggressive with loans, because like the newer banks are typically going to be like that, but like the older school ones are going to be like way more conservative.
So if you want to get like a more chance to getting a loan, you go to like a newer bank. They'll have more chance of you.
Yeah, like a more flexible, aggressive one that wants your business versus the one that's like, oh, we got enough business. Like we're cool with where.
How many banking relationships would you say you have, or like lenders or banks, like at this point in your Rolodex?
I don't know. Well over 50.
Okay.
Yeah. Okay. And it always changes though, because like we have some that's they just specialize in like a particular thing, right? Because we work with mostly direct lender people. So like all they do is fix and flip. All they do is commercial real estate. All they do is equipment. All they do is working capital. And then we got to have like A credit, B credit, C credit for kind of like all those. So we kind of swap them in and out quite often.
So you just have like this giant spreadsheet and like in your office, like, hey, like where do we need to place this guy? And you just kind of look at all the different options and you try and strategically align and put them to like different areas.
Exactly.
Very, very, very cool. Is there like, I mean, like, is there a specific type of loan that we need to like watch out for? Or, like, because you're in the loan industry, is there anything like anything you can tell us more about just like loans in general, like what to do or not to do or what to look out for? Let's say I'm taking out a loan.
Well, I would say like a little bit red flag if you're getting a call from Florida or New York.
Okay,
they're very notorious for like,
because I get
aggressive.
I get spam calls all the time saying, "Hey, I've got a business. You've been approved for like $500,000 in business credit." So like, are those guys legit or what's it like?
Some of them actually are, surprisingly.
Okay,
but you just need to do your due diligence, and also you can't even trust like what's on the review sites, unfortunately, these days. I mean, I think Google is still pretty intact, but there's some,
because we can just spam the spammy review sites. That's why.
Yeah, they'll do bots and stuff. I see. I would just say like stay away from MCA loans.
What's the
these
MCA
merchant
loan?
cash advance loans.
Okay.
it's typically like daily payment, weekly payment. It's very short term. There's also QuickBooks. Like QuickBooks kind of is like basically MCA loan.
What do you mean by like?
So they give you like 1 year to pay it back.
QuickBooks, like the accounting software, they actually give out loans.
Yeah.
Okay, I didn't know that.
Yeah, and people take them.
And what kind of terms are you getting with this guy?
Usually like 1 to 1.5 years term, but the rate's typically like 20-something%, around 20%. Which is, it's not the worst thing, but what happens is people get addicted to it. It's like drugs, right? So like they'll take one loan for 20-something%.
Okay.
And then they got to chase it. So because it kills your cash flow because you have to pay it back so fast. You're paying it back daily or weekly. So after they do one, they got to do another one in like a couple months to pay that off. And then, like I got this other project, so I need another one on top of that. I just talked to a client before I got here. They're doing like $8 million in sales. They had $2 million in merchant cash advance loans.
Okay.
In the last year. That's ridiculous. Like that will completely obliterate your cash flow, right? So I say that those loans are okay, but you always have to have an exit strategy in mind. Whenever you're getting into any type of financing situation, like how am I going to pay this off? Right? What is my ROI? How am I going to pay it off? Is my ROI better than the interest rate that I'm getting?
Yeah.
Like, am I borrowing money? If I'm borrowing money at 10%, like you get private money.
Yeah.
But you're going to make 30%. All day long. You'll pay 15% for that, right? Like I would. So same thing, like, okay, if your interest rate is like 30%, but you're going to make back like 60, okay, yeah, you could do that once or twice. There's better options, and that's what we strive to bring to the table.
That's a really good point, because this is what I see with newer investors is let's say they want to buy a rental property. And they're like, hey, I want to buy this rental property for $100,000, like let's say like in like Indianapolis or whatever.
Yeah.
And it's like, hey, it's going to cash flow, whatever. But then they borrow money for the rental property from a private lender, but the borrowed money is a higher interest than what they're making in cash flow from the rental property. And so it's like you're shooting yourself in the foot because you're like, hey, like you're told to like, hey, just buy rentals, let's build my wealth. But you borrow from somebody at like, let's say at 12%. But the rental is only paying you, let's say, like 5 to 7% on cash flow.
Right.
And you have like unexpected things like, let's say, like vacancies or repairs and things. And so like you're kind of like and then now that you brought this money and you're negative on your rental property, like you can never get out of it because like the rental property is never gonna be able to give you enough money to pay back the loan you took. If you sell it for like, let's say, a loss or you pay realtor fees, you're gonna owe your private money lender more than you're gonna have like less money to pay them back. So
exactly,
this is just like a math equation that I see a lot of, I think, newer investors run into, and just as a cautionary tale, like just be aware of how much your money is. Exactly what you're saying is, even a small business, if you're borrowing money at a certain rate, what is that going out and doing for you in your
exactly, yeah. Asset. And like I challenge business owners and investors, you want to look at like the big picture of it, right? Like what kind of loan are you getting? What is you really need to start with the ROI. Yeah. Right? Yeah. Like that, it doesn't matter if you get a 0% loan. Is the thing going to make you money or not?
Well, I mean, if you get a 0% loan, that's like there's no way to lose. Well, I guess.
Well, I mean, if you make a bad move, like if you're going to go do all this work to make like 2%, then should you do that deal? Probably not.
That's true, actually.
But even if you got to pay like 100% for a loan, but your ROI is like 500%, like guaranteed, I would do that. Yeah. So it depends on the situation, like if the interest rate is going to be worth the squeeze. But then if you are going to pay those high interest rates, like, okay, what is my exit strategy? Yeah. A lot of the times for us, the exit strategy is, well, we're going to get better personal credit and business credit in the process and be able to refinance this later on and get access to way more money. So it's totally worth it in the big picture. Short term might suck a little bit. You're paying a high rate, but like you're going to be set up for the long term.
Actually, this is very interesting because it kind of mirrors what we call like the BRRRR strategy, where let's say like you buy a house with like a short term, very high interest loan, right? You fix it up and then you do a long term refinance on that to take out the loan, the short-term loan that you put on it originally, replace that with a long-term, lower interest, higher or longer term, so like your interest payment is lower, and then it'll quote unquote cash flow. So then now like it's basically the thing is like you're looking at the ROI in the long term and the short term, and knowing that you have an exit strategy like down the line.
Yep, exactly.
That's really interesting. I mean, basically you can do the same thing with the business, right? It was like I say, like I've got a deal or whatever thing is, or I've got a strategic move that I think I want to make. I can't qualify for like let's say a long term loan right now. I'll take let's take a short term 20% or 30% like line of credit or loan to get my credit right.
Yeah.
And then now I can take out another loan at a lower interest rate to replace that original short term loan that I took out. So
Exactly. Yep.
very interesting. Is there maybe like a story about a big deal that you guys did to help out any companies?
Yeah, we did one this summer for a construction company here. That was interesting. I actually got it from a CPA. But
so like a CPA referred you, say, hey, like we have this guy who needs some like assistance. Do you think you can help him out?
Yeah, because basically like was it Bank of Hawaii?
Okay.
They couldn't do it, and the guy had like big line of credit of like $3 million.
So $3 million line of credit with Bank of Hawaii or another bank? Okay.
Yeah, Bank of Hawaii, and then Bank of Hawaii was actually closing their line of credit.
Oh wow! So this is one of those times where like they had like I had a large line of credit, and like the bank's calling it due.
Yeah, and then they tried to finance it through like some like Pacific Guardian something or other company, but they couldn't get the numbers right. And then I was like, well, what, how much is your property worth? They're like 10 mil. I was like, I can get that done pretty easily. Like, really? Are you sure? Because they said no, and I was like, well, if the property's worth 10, you only need 3. Like, yeah, we could get that done. So long story short, we got that deal funded for the client because they had a lot of new government contracts coming out.
Okay.
So they're going to be okay like later, but they just weren't okay right then. Yeah. So we just leveraged the property to just get them a bridge loan real quick, move them out a little bit. They need to file new tax returns to get the new line of credit and stuff like that and the refinance. But we got it done in like less than 60 days.
Wow.
And it was funny that that exact same client, we went to get him a new line of credit, like just small kind, just for like buying inventory and supplies and stuff. It was like $50,000. That deal took longer than the refinance of the building. And I was like just blown away. Like local bank took longer to do $50,000 than $5 million.
Wow.
But we did the $5 million through like, it was more like private money. Bridge loan.
But I mean, so that just speaks to like having the right connection, because I think even like when we're as a business owner, we could run into problems where if we just had the right connect, we like it's like so many times in our business where it's solved problems for us that we didn't know the solution existed because we didn't have the right connection. And then like when you have the right connection, just like, okay, like there's a solution that this person can provide that I didn't even know was possible. I think in the beginning it was like things like a DSCR loan. Like I didn't know like that was, or that was possible. I was like, okay, I always got to apply with my DTI or my credit. But someone brought a DSCR loan and said, okay, wow, I didn't know you could do this. And then later on people were like, you can't finance Airbnbs. And then I found a guy who's like, hey, I can finance Airbnbs. Or there's always like, even like contractors like, hey, like I can't get this type of like, this kind of like material that I need for like this particular project or this like type of cabinets, and like so nobody has an island. Yeah, this guy has access to it and he can get it to you quickly. There's so many times where the right business relationship can literally like change the direction of your business.
Oh yeah, I mean, well, this because you do all the meetups and stuff, but like that whole saying of your network. Yeah, your net worth is like the result of your network. Yeah. That's so true, especially on the islands. Like that's what I learned. Yeah. From a long time, like even being a visitor here, I knew that, because it's very communal here, and it's just who do you know? Like, are you in or are you out of the crowd?
What's kind of like your strategy to, I guess, meet more people and get more connections?
Like in 2022. Right after COVID kind of lifted, then I just went hard at networking, like at least 1 to 2 per week.
Really?
That's all.
How do you, I mean, like, I didn't know there's that many events like that's available. Like,
yeah,
what
I mean,
kind of events do you go to?
You can find them. Like there's recurring events. So I kind of found like one recurring event that would happen. So I did that for a little bit, and then I'll try and find like one new one per week. And I did that very consistently for about 18 months.
Okay.
And then it took a while for it to get a lot of traction. But then once it did, then it was like.
What's kind of like your strategy when you go to like these networking events?
Meet a lot of people, see how I can provide value to them, like help first. I always like to make connections for people because like, I'm like, well, I know, like I met all the people. I went out to all these events. So like, yeah, if you need a bookkeeper, you need a lawyer, do you need real estate
you have
guy
like a large Rolodex of just people that you meet or the course?
And then I just give it out freely.
Are you taking notes? Just curious on like your...
not really. A lot of it is honestly in my head.
Okay.
Not a great place to be, but I mean, I have stacks of cards at home.
Because I mean, like for you, I mean, just looking at your business model is number one, you need to have like access to all the lenders. So you need to connect with a lot of different lenders, and like whatever, like the strategy side, but you also need clients. So it's kind of like there's two sides. You're networking for your business and you're also networking for your clients, like at the same time.
Yeah. I mean, it's kind of cool because that's basically my job is to be a collaborator, which I think I'm just kind of, like I just naturally gravitate towards that. Yeah. Like I like talking to people like this, just talk story. And then I can help them to identify what their actual need is. Like I can help kind of dig down to the root of what it is. And then it's like, okay, well, what would be the like hinge that's going to move the needle for you? If I have access to that person, like, yeah, I'll just, here you go.
I mean,
then that person, you know, whether it be an insurance person or like CPA or whatever, they're grateful that I did that.
Yeah.
And so they're like, oh, well, next time, like, I'm going to find a deal for Jason.
Yeah.
And then it comes back. It might take a year. I don't know.
Yeah.
I don't care.
I mean, it's kind of funny the way like the world or the universe works where you're just putting value to the world. Like you're connecting people. You're not going to get any benefit from it immediately. I mean, or maybe never. Yeah. But somehow like that good karma eventually comes back where like they appreciate it. You've got a good name and people are like, hey, like I like working with Jason, or I've had a good experience where he helped me out without explaining anything in return. Yeah. And then now they're like, yeah, I feel like I owe you. Like I want to help you out in some other way. Like, you know, it's funny how that works.
And it's like it definitely, it's something that I learned along my way. Like I didn't have that mentality when I was younger. I was very, much more about myself.
Yeah. I think a lot of us start out that way because it's kind of survival, right? Like it's a lot of times it's like even like giving like freely or being generous. Part of it is mindset, but it's also like if you're in survival, it's just harder to be generous. I mean, you still can. There's a lot of generous people who are in survival mode. The kudos to them, but like a lot of it is like when you have breathing room, now you can think, okay, how can I spend my time to help other people as well too.
And I think I've been around a lot of people and like read a lot of books. I would do a lot of like I don't know,
personal growth kind of things.
Like personal growth type of things, you know, like I like to improve myself and stuff like that. So over time, I just saw, you know, the writing was just on the wall. Like this is like, it's like basically like a scientific thing, you know, like what you put out is what you're going to receive.
Have you read the book, The Go-Giver?
Oh yeah.
I mean, that's my favorite, the whole series,
favorite
right?
Sales book,
but it's exactly what you're talking about. Where like
I feel like that character was me.
Really?
Because I was that guy. Like I was like, kind of like, you know, number one sales guy, like doing all the things, but like it was me doing it. And it was like my hustle and grit that got that. Yeah. But then in the end, you know, like he changes his mindset around for the better. And then he's like giving. The
thing too is like a lot of times the giving, it's like a long-term play. So it's the same thing. Like there's like the short-term money, there's like long-term money, right? So like just like rentals or flipping. So like when you're grinding, hustling, you're getting business for yourself, whatever, you're making short-term money. But when you're getting the value into the world and you're just giving, it's not an immediate impact, but it's like longer term, but it compounds. And the value is in the compound. So now that you've been giving for like a long period of time, like you've built a good name where people like remember that. Now like it's, the compound effect is so much stronger than like the immediate like running the hamster wheel. So.
Yeah, and to your point, like it took me a good, I would say like 18 months to really get the traction going. in the Hawaii market. Cause we moved here almost 8 years ago.
Okay.
And, I didn't have,
because you don't know anybody, like you're not local, you don't have like the connection and stuff, and so you basically have to like claw from the very beginning to build it organically over a period of time.
Yeah, but I mean, we moved from California, and then I don't know if I shared my story, but like when we first moved here, we didn't know if we were gonna stay, and then 2 months in though, we got pregnant. You're
okay. Your wife. Yeah. Okay. Was that your first child?
Yes.
Okay.
So we were planning to be nomads, basically.
Okay.
We were gonna go to Bali or something, right? And this all kind of happened because, like back in OC, I was like successful on paper, but when I hit all these financial goals, I was like empty and like depressed, and so I was like, okay, well, I guess that wasn't the thing. So we need to make a change. So I'm like, okay, I didn't care what was gonna happen. Like I was kind of just over it because I was like, what's the point of all this, right? So I was like, let's just go travel, and then that's how I kind of got here.
So you guys were only planning to stay here temporarily.
Yeah, like I think my wife she really wanted to live here. I was like, whatever, like I'll live here, I'll live in Bali. Like I just want to be free for a bit, and then God had different plans.
So you guys got here. You got your wife got pregnant, and then like how many kids do you guys have now?
So we had so the first pregnancy was twins.
Okay, wow.
Yeah,
wow. Congratulations on that.
Yeah, it was definitely tough for the first go, with no real network here. So we put everything on pause basically back then, like anything entrepreneurial, and then
what were you guys doing for money at that time?
So I kind of like put an arm's distance from my finance company that I was still associated with on the West Coast. But I got back into it, just kind of doing deals with like repeat clients and stuff, like living off residual income, really. That's what I did for the first probably like 3 years.
Okay.
And then right when they turned 1, we're like, okay, like we're ready to get out into the world and like do this thing. And then we got pregnant again. So we had 3 under 2. And then 5 months later, COVID.
Oh, wow.
So that's why I said I didn't really have a Hawaii network until 2022.
Because during the COVID, like you can't go out and talk to people.
Yeah, and we, our lifestyle was just stay at home and be with 3 babies anyways. So we're not going to go nowhere. And then, but like I really didn't get much business out of all that networking. I was pretty frustrated actually because I was like, man.
So like you're going to all these networking events, giving value, connecting people, but getting no business for yourself.
Yeah, because back then my main focus was equipment, but there's no equipment vendors in Hawaii. So I was like, I need different offers.
Yeah,
in
to
finance.
match your clientele or like the opportunity. I think this happens in business all the time where
Yeah.
you're very good at one scale or like one type of like product, but then let's say the economy changes or your geographic location or whatever happens.
Mm-hmm.
Now this product is not as relevant anymore. It's you as a business owner, entrepreneur to figure, okay, I need to pivot and go to where like the ocean is.
So that's exactly what happened. So like beginning of 2022, I had a partner back then, and I was like, dude, this equipment is not. This is not the jam out here. Like, we need some other offers, whatever it is. But I got all these business owners that need stuff. So we, it just kind of landed in our lap to do the ERC credits, employee retention credits.
Okay, is that for like the COVID thing?
Yeah, it's basically like free COVID money for small business owners if they were negatively affected. So we got really good at that, and we already had Rolodex of like potential clients. So I started doing that to just like serve the local community and make relationships here. I did a number of those, and then that led to like a minuscule amount of finance deals. But then over time, I would basically just ask people, what do you need? And they're like, oh, I'm doing this startup. I need like 50 grand, or, I need like 100,000 of working capital. And honestly, the only program out there is like those MCA loans. So I was like, well, I don't want to sell you that. Like, I'm not even gonna help you. But I had so many requests repeatedly from that small business owner that needed like 50, 100, 200,000. Like, let's just serve them, and then.
So you kind of work backwards to find a product that fits the customer.
Yeah.
After seeing the need for so often, you're like, hey, like this, that I see a repetitive or like a consistent like need in this particular niche. How can I create a product or an offering around this need?
Yep. And I actually had a short kind of partner mentor for a bit. He's very savvy, like finance guy from the mainland. And his specialty was like commercial real estate, like very large deals, working on stuff like 20 million, 50 million. And then he's like, Jason, I don't want to work with anybody unless they're needing over $1 million. And I was like, good luck in Hawaii. Like, that's not, we can only do real estate then. I have people coming to me for like 50, 100,000. I can still help them. Like, these are the people coming to me. He's like, well, just go do it then. Just don't do it with me. I was like, all right, then I'm going to start my own. And so we started our own company last year. And then,
how many loans people do you think clients do you work with every year now?
Every year? Well, we've only been in business for like barely a year.
Okay.
For Pacific Business Funding.
Okay. Yeah. And how many clients have you guys helped so far?
I don't know, something over 100.
Wow. For only over a year, you've already helped 100 people?
Yeah.
Wow, that's really impressive.
Yeah.
Because that's like one every 3 days, basically. Around there, one every 3 or 4 days.
Yeah, about that. So. Yeah. My goal is to actually be doing, I count my days as like Monday through Friday because I don't really work on the weekends. But I want to be doing 2-3 deals a day. Yeah. The need is like so big. Yeah. Even if it was just Hawaii, I think the need is so big, especially for the credit stuff. I
haven't really come across too many other guys that are offering what you're offering. Besides, like, I'm not sure if they're spam or not, right? Like the guys are like, hey, I've pre-approved you for $500,000 in line of credit, whatever. Like, give me a call. So I never call them back because it just seems too like.
Yeah, I mean, most of the time it's probably not great.
What do you think they like? What are those guys? What are those like calls? Like, what are they gonna offer me?
They'll mostly likely offer you the MCA loan.
Okay.
Yeah, so it's like a 1-year term. Usually average about 35%.
35% interest.
Yeah.
So 1 year
35% payback. Yeah.
So 35%. What do you mean by?
Like if you borrow 100, you're gonna pay back 135.
Wow. Okay.
Yeah, over a year.
That's an insanely high interest loan.
Yep.
So those, I can see how they're making some money on that. So.
Yeah, I mean, a lot of it is like you're gonna hit people at a desperate time, and then if they need it, then what other option is there? There's nobody else calling them. So where else would they go?
Interesting. Very interesting. Yeah. So so they will give me the money. It's just gonna be like at a stupid interest rate. So.
Most of the time, yeah. There's a couple that's like they have like long-term loans and stuff like that. But just watch out if they're from New York. No.
Or Florida.
Don't do that. Yeah. A lot of spam and just very aggressive out there.
So, I mean, like, after, like, looking through all your different cases and working with so many different people, you probably see so many different scenarios and things.
Oh, yeah.
You'd be like, what's, like, is there a common thing that you see, like, people do wrong that they need to fix?
There's definitely 2 things. So, the first thing is commingling.
What do you mean by that?
So, putting business activity on the personal credit, whether it be loans or credit. And then the second thing is the utilization. So, they're overutilized and they'll max out one card, but then they won't use this other card. If you have a consistent, like across the board, if everything is at 30% or less utilization, you will naturally just have high scores.
Does it count your mortgage as well too?
Nope.
So it's just like, it's a credit card or line of credit? Just those two.
Unsecured. You can have high.
So HELOC is okay.
Yeah, HELOC's okay.
It basically doesn't count on your.
Correct. Yeah, they count that more as like a loan. Yeah.
So if it's an unsecured line of credit or a credit card, those are things that you gotta keep lower.
That's what you need to keep at 30% or less.
What about like a car loan?
No. So if you need more credit, then you could apply for more credit. That's okay. Having 100,000 available or even 200. It's. Ideally, like we see like 50.
Does it affect, like, let's say you have like your business credit and you have a high business like utilization? Does that affect your business credit score?
Yes, but it's not like a deal killer. You know,
like
unless you're applying, like if you're, let's say you're maxed out at like whatever, B of A.
Okay.
And then you go apply for something with B of A, they don't like that because you're maxed out.
I see.
Yeah. Okay. So like if you have a maxed out B of A,
but there's no like credit score that's associated with that.
There is credit scores, and there's like, there's a lot of different.
But it's not utilization ratio on the business side.
There, yeah, it does play into effect, but it's not as big of a factor. Yeah. Okay. It's basically like on the business side, I just tell people, just make sure you pay your bills. You know, don't have tax liens, don't have judgments. If you're maxed out on stuff, that's not going to hinder our ability to get you approved unless we're going back to that specific bank that you're maxed out. On the business side only, yeah.
Okay. That's really helpful. Well, any last piece of advice to young entrepreneurs who are just trying to find their way?
Yeah, actually. So there is a really big theme of people, you know, they got all these different businesses.
Okay.
And they're not successful. You know, they think that they're successful because they got like 4 businesses. But all of the mentors that I've had over the years that are actually wealthy, worth like 8 figures plus, they tell me the same thing. One business, have that business produce golden eggs for you, and then you use that money to invest into the next business. Unless, like my mentor right now, he tells me, Jason, you're not doing anything unless you're hitting 7 figures a year. You cannot start any project.
Don't do anything else until you maximize this one lane.
Max out on that one lane. Use the overfill to then go into the next business. But when you're doing 250K and you're trying to start this other side hustle thing or like buy some company or whatever, your attention gets split. And I think that's what I was doing for so many years, like looking back, like in my younger entrepreneur journey. And I was not successful, you know, just completely burned out also. But now, like, this is just focus the jam. And I already see the opportunities. Like, I get shiny objects thrown at me every week now. Like, oh, you buy this business. Or
the thing is, like, because you're funding all these businesses, you see, oh, this business makes a lot of money. Oh, this business makes a lot of money. Exactly. Like, this, and from the outside, obviously, like, you see, like, okay, like, I should jump to this lane because, like, you see all, like, you have, like, basically 1,000 shiny objects because you're like, that's all you do is you have shiny objects, right?
Yeah, so. Exactly. And especially like real estate, because I was in real estate investing like earlier on, and then I kind of got away from it, and now we're coming back into it. So I'm already kind of like, I see it coming. It's probably going to be next year when I really hit that space, because I'm like, man, like I know all the people, I'm the like people are even coming to me like, oh, you're the finance guy, like you can get this stuff done, like you can make deals happen. I'm like, okay, but not right now.
yeah. Super interesting.
Yeah, not yet.
Well, if people want to reach out to you or find out more about you, what's the best place to do so?
Probably Instagram.
Okay.
So at Pacific Business Funding. We also have a YouTube channel, so you could search that, Pacific Business Funding as well. I'm on IG too, but I'm pretty much just have time to manage the business account for right now.
Too many IG accounts is counterproductive. Same like shiny object syndrome. So
I usually just use the business one and then just repost through the personal.
Nice.
Yeah.
Well, thanks for coming on the show, bro. Super appreciate it.
Thanks. That was awesome.